Right, thanks very much for joining me, everybody. Hopefully over the next hour, you'll find it useful. What I want to do is just go through the way that I analyze the deals that I do. I'll show a model that I use and the various stages that we go through. And then if any time you've got any questions, happy to take the questions at the time, or you can wait until the end. I'm okay after the hour. So if anybody wants to stay on and ask more questions, happy to do it. But if you have any questions now, we shall crack on. I will share my screen. And we'll go there. And we'll go up to the top. Give me a second. Anybody see that? Let me just go to... No, is that not coming through? Just 1 second while I get back into here. Page there. There. And slideshow. Right. There we go. Let's try again. Can we all see that?
Yes.
Yeah. Good. Yeah. Okay. So, I mean, I joined. I'll give you a little bit of background. I don't like to dwell on things like this because I don't like particularly talking about myself. But what we'll do, where are we? From the beginning. There we go. So, what I'm going to do is we'll go through a little bit of background on me. We'll cover some of the information that I ask for when we're starting to analyze a deal. We'll go through the process itself of financially analyzing a deal, some of the things to look out for in the numbers. I'll then give you a demo of the model that I use so you can see what I'm entering and why I'm entering it and what it gives me. And then there's a little bit else. If you need some support, any help, we'll show you how we can do that, how we can help you with your deals as well. I joined the Harbour Club back in July 2020. So I think we were the second course that was done remotely because of COVID. 6 weeks after doing the Harbour Club, I bought my first company. So my background is finance and accounting. And during corporate life, I've been part of an M&A team. It was a PLC, and it gave me an opportunity to get involved in businesses in the UK and abroad. And it gave me an insight into M&A. And it wasn't really until COVID comes along and all my consulting work that I was doing stops. I thought, well, now is the time to go back and learn M&A and fill the gaps in that I knew I'd had lots of gaps in my knowledge, but I found Jeremy's course. I'd also found another course on leverage buyouts, which I did. And I've been doing this ever since. So I think it's just coming up to 4.5 years now, nearly 5 years. I bought 8 companies in that time. I've sold 1. I've got minority stakes in 2 of the businesses in Canada and North America. And I wish I'd discovered this 10 years earlier, in all honesty. I just love doing what I'm doing. What you're going to see today we've used to help, it says on 30 on the slide there, we've now done over 200 analyses for different people, either in the Harbour Club or elsewhere. So hopefully, you'll see the benefit of what we're about to show you. So what I always ask for, once I've had an initial contact with the seller, we've had the first call, we've started to build some rapport. What I'm always keen to do by the end of that first call, if I want to continue to work with them, I want to sign an NDA. That gives me access to the financials. And what I always ask for is 3 years of statutory accounts and the published accounts here in the UK. I think you've got a few guys here from the US, so tax returns wherever we can. I'll also look for the current year management accounts as well, because some of the statutory accounts are typically they're out of date. So it's going to give me some information, but not the latest information. So I'll always ask for management accounts. If I can get my hands on them, I'll always ask for sales and gross margin reports for the last 3 years. If in the very least, I'd be looking for the last 3 years, top 25, top 30 customers. An age debtors report, I'm happy for it to be redacted. The key information that I'm looking for is the profile of the debtors to see how old it is. Are there any potential bad debts in there? And just have a look at how it's shaping up. The same thing with age creditors. How old are some of these creditors? Potentially, if I've got something I need to deal with post completion. And the other thing is a fixed assets register. And the reason why we ask for this, you'll see this in the demonstration in a few minutes' time, is that if you've got assets that are starting to age, you'll start to see more and more repairs and renewal costs coming through. So I want to understand, if I do need to replace some of these assets, when is it likely that I need to replace them, so I could build that into my cash flow forecasting. The process itself is I put into the to the model I've got historical profit and loss accounts, balance sheets, and the current year management accounts. It's going to then give me a series of current ratios, key ratios, and I can start to understand the trends in the business. And it will also help me to understand what I don't know that I need to understand better. Once I've done the historical analysis, what I then do is look to produce an initial valuation, and then I also go on to produce a set of 5-year financial forecasts. Now, the idea for this, if I can produce a set of 5-year financial forecasts, I then know, let me somebody else in 1 second. I can then find out how much cash this business is likely to generate once I buy it. If I know how much cash this business will generate, it will then start to suggest various deal structures. And from there, I can produce alternative deal structures that I think would work. And I would prepare up to a series of six offers. What I then do, once I've done all of this, I can look at various scenarios. I can also then prepare a list of follow-up questions for the seller. From here, bear with me a second. There we go. Okay, some of the things that I look out for when I'm analysing deals, gross margins. So one of the ones that sometimes happens is that sellers will load up the stock or revalue the stock upwards. That has an impact. If you're increasing stock, you're reducing your cost of sales, which increases the profitability, which makes the business look more profitable than it actually is. So keep an eye out for things like that. If you're dealing with brokers, the brokers love an EBITDA adjustment, and they'll come up with all of these weird and wonderful things that they'd like to adjust it to make the business look, again, more profitable than it is. I would always challenge every one of them. Sometimes they may be justified, but always challenge them. As we go through the analysis and in the example you're going to see, there are various things that appear in overheads that are unusual. The best one I ever saw was the owners had actually built an orangery and charged it to the business. 18,000 quid in repairs and renewals. Anyway, that's probably one of the more bizarre ones that I've ever seen. When we look at the balance sheet, a pet hate of mine is other debtors and other creditors, because it can hold all manner of things. So whenever I see a balance in other debtors or other creditors, I always want to understand or get a breakdown of what is in there. Now, sometimes you'll find it's a director's loan. Sometimes it could be even intercompany balances, or it could be soft loans. There's a whole host of things, but we just want to understand it. It may not be wrong. We just want to understand what it is. Short-term liabilities. Recently, we've come out of COVID, as we know. So in the UK, you will see things like time to pay agreements with HMRC for VAT and for PAYE predominantly. But we really wanted to understand, are any of these salary-related costs or any of the taxes higher than you would normally expect them to be? If that's the case, again, I would go back to the sellers and try and understand what that is. Because if I know there's a time to pay agreement in place, it may be fine, but I need to know what it is for when I'm forecasting cash flows. Long-term loans, that could impact my ability to raise new finance to get a deal done, or it might even be that I walk away from the business because it just limits what I can do with it. Once you start to take into consideration long-term loans and deferred consideration payments, it may make the cash flows too tight. Using something called, we look at something called debt service cover ratios, and I'll come on to that. Any questions so far? No? Okay. So this model I've developed, it says over the last 3 years, it's probably over the last 4 years, 4 to 5 years that we developed this. And it stems from the fact that the courses that I've done typically say, go and find a good accountant. And there are some decent models there, but they don't go into it in any great depth. So I just wanted to put something together. So my background is not only accounting, but also financial modeling. So I've just looked at elements of other models that I've seen. I thought, well, let's see if we can put something together that ticks as many boxes as possible. And over a period of time, we've updated it. We've added things. When we've worked with other harbour clubbers, I said, well, it would be great if it could do this. So we've included that. So you'll see in a second, it's now become what it is. I think we're up to version 3.2 at the moment. Next from here, one other thing I'll mention on this, we've used this successfully, this model, for raising finance in all of our own deals, because it encapsulates the history of the business, your forecasts, evaluation, and various scenarios that we can demonstrate to the seller, which gives them confidence. We will send them the model, we will send them the statutory accounts, so tax returns, as well as a business plan. We tend to find that we get some good feedback from using this. So what I'm going to do, I'm just going to stop showing this one. I will go into my spreadsheet and we'll start to look at that for you. Bear with me. There we go. Can we see that? Yep. Good. Okay.
Yeah, I can see it now.
So main menu. So what we've got in here, on the left-hand side, we've got the green tab buttons, really looking at all the historical information that we put together for people. Then we go into the actual valuation of the business and the deal structures. We then, if you look at the purple section, we've got all of the scenarios. Well, if we change certain things, what is the impact to the business? And at the end, we've also got a few things that we could cut and paste into slide decks or a business plan in preparation for raising any finance. We'll go through these tabs one by one so you can see what it is that I do and how and why we do it. In terms of this first screen, we're here really collecting information about the business. So I really want to know, how old is it? When is the year end? Where do we source the deal from? Who are the ownerships? What the ownership structure looks like? And we can see at the bottom right there, the accounting periods that we have the available information for. On the bottom left, we've got these sections here. Now, in the back of this model, we've got all of the EBITDAs per sector from bizbuysell.com. So we get that information every year and update this model, and we can use those EBITDA multiples as a guide when we're putting together a valuation. So whilst you won't see the drop down in here, if I go into here and select something different, if I select online technology, it's then going to give me a different set of businesses in here. And if I select one, you will see the multiple change. So you can see now the average multiple for 2023 for this sector was 2.75. But now I've got a guide. It's not the multiple to use, but I've got a guide as to how I might structure the valuation of the business. With that in place, what I'm now going to do is start to look at the historicals. So we start to enter in everything from the statutory accounts or the tax returns. And just so I'm sure you're all aware, there are two sets of figures that your accountant will produce. There are a set of accounts for smaller businesses that go to Companies House, which won't include the P&L, or is the copy that goes to HMRC for corporation tax purposes that does include the P&L? That's the version we want because it gives us all the information that we're going to look at on this screen now. So I'm entering sales, cost of sales, other income, and then we're getting to all of the operating expenses or overheads. As I go down, I start to highlight in a darker yellow where I wouldn't understand it. I'm not sure. I think I know the answer, but I'm not going to guess. I want to get a breakdown or get an explanation from the sellers. So this is a good example. If you've worked with sellers who are looking to exit and retire, quite often they'll load up their pensions in the 2 to 3 years before the exit. And that's fine. There's nothing wrong with that. But at least now I know to discount that. I can remove that from any forecast that I produce because I don't have to pay that going forward. As we go down, we can see here travel and subsistence. To me, that seems high for this particular example. So I will just go down and just analyze everything. Here, we've got an accounting. We've got some accounting costs, which are preparation for sale. Again, we know that we won't have to incur those going forwards. We've got some consultancy fees. Let's understand what they are. And down here, we've got repairs and maintenance. So if I see this getting higher and higher to the point I made earlier on, then it's going to prompt me to ask for the fixed assets register so I can understand how old some of these assets are and subsequently when do I need to replace them. Once I've entered everything else in, I've now got to EBITDA. So I've now got a trend. I can see any trends in the business. If I look at the top, I can see revenues are increasing. Gross margins, other than this year, are pretty stable. I'm starting to get a feel for how this business is performing. I'm also including in there any dividends that the owners are taking out of the business. So now I've entered all of the P&L information. I'm going to do exactly the same again on balance sheets. Enter everything in from the statutory accounts. And wherever I've got the information, I'll break it down. As you can see in this particular example, other debt is 24k. I'd want to know what that is. It's not a huge figure in the grand scheme of things, but I want to know what it is because I just need a good understanding, as good an understanding as possible of what's been happening in the company. Debtors we'll come back to in a second. And when we go through to current liabilities, you've got the standard ones. There's a small loan in there. We've got some social security, corporation tax, VAT, as you might normally expect to see. We've got an intercompany balance there. So again, I'd want to understand what that is. And then accruals and deferred income. Okay, again, I would get a breakdown of that. Finally, any long-term liabilities, deferred taxation doesn't concern me. It's a paper transaction. I've got some long-term loans and a small bank loan outstanding there as well. Once I've got all the historical information in, it's now going to produce, this will produce a series of schedules that helps me to understand business performance. First one, cash flow statements. In here, I can see exactly how the business has generated its cash. I can see all the positives and negatives in here, whether it's red or green. What capital expenditure has been incurred between the 2 years. Dividends that have been paid. Any long-term debt that's been raised. And what this is doing is just helping us to understand how, the cash balance has moved between one balance sheet or one set of accounts and the next. In terms of key ratios, I can enter in from the accounts how many people the staff have got, how many the business has got. This tells me one of the key metrics that I'd like to look at is revenue per head. I look for a minimum of 100,000. Now, there are exceptions to that. The accountancy businesses that I've bought in the past, typically 58 to 65k. But typically, I'd look for £100,000 plus. It helps me to understand how well this business is using its resources, its human resources. We've got some P&L ratios here. And then the next one, when I mentioned earlier on debtors, here's our debtor days. So it's all on, it's like it's got a formatting in there. So anything less than 30 days, we're happy with. So it'll turn green. Anything between 30 and 60, it's amber. So it's okay, but could be better. If it's red, it's particularly high. It's not the end of the world if it's high, if I've got a way to solve that. And it could be an advantage to us if we can get those debtor days down post completion, because it obviously will put cash back into the business. Some balance sheet ratios. So we're looking at the stability of the balance sheet in here. We can see it's pretty stable, pretty healthy. And then we've got a return on equity. So now we've done our historical analysis. We've got to start to get a feel for how well this business is doing, or not, as the case may be. And it's starting to give me some ideas about what I want to ask the seller and what I could potentially do with the business if I acquire it. I mentioned the management accounts. Ideally, I'd like to see management accounts month by month, because then I can see any seasonality in the business. So the last company that we bought was a walk-in hoarding company back in October last year, or one of our most recent ones. That's seasonal. So we don't expect to see walkers going out from any earlier than 1st of March. And typically by the end of October, the season's finished. But now I can start to see how the profile of revenues and profits, and also then it gives me an idea of what the cash flows might look like. But if you can't get it by month, then what I tend to do, whichever month I've got, whichever year-to-date month, I'll put that into here, into the relevant column. So in this particular example, we're 5 months into the year, so I can put the year-to-date profit and loss account in, and then I could forecast the remainder of the year, depending on the discussions or subject to the discussions I have with the seller. In terms of any charts, if anybody gets, doesn't like looking at page and page of numbers, there are some charts there. First 3 bars in each case are historical figures. The different colored bars are current year. We can cut and paste these into slide decks or business plans. Again, it's just something that's helpful to stick straight in. The model is actually doing some of the work for you. Then we get onto the valuation. So what we've got here, we've got our business, we've got the sector that it's involved in. It's pulled through for us the suggested or the actual average multiple from biz buy sell at 2.75. And then we can decide, do we want to look at all 3 years? Do we want to look at the last 2 years only? That was more relevant really for COVID. Or if there's any real volatility in the business, you may only want to look at the latest set of accounts and base your valuation on that. Let's assume for this example we're using 3 years. It's pulling through for us the EBITDA from our historical profit and loss accounts. We then apply our multiple, and it will work out an initial valuation for the business, which we then make a few adjustments to. The first one is a cash adjustment. Now, the way that we look at this, and certainly the way that I look at this, I will take a minimum of 1/12 of revenue. I then compare that to the bank balance. The idea being, if I take 1 month's worth of revenue, if it comes out at £100,000, but the cash balance in the business is only 50, I've got a cash deficit. So it's under, the working capital is lower than it should be. So what I then do is reduce the valuation accordingly by that amount. In this case, what we can see here, that we've actually got it for 1.5, we set it for 1.5 months of revenue, which calculates at £574,000. The balance, the cash balance in the balance sheet at the last set of accounts was 545, to give us a shortfall of 29k. Next thing we adjust, any long-term loans. Could be bounce back loans, C-bills, or any other long-term loans that the business currently has. My argument is I'm quite happy to take those loans on, but I'm not paying for the benefit of it. So we reduce it by the value of the outstanding loans. There may be other adjustments. Last one is any property that's associated with the business. I will put the independent valuation of that property that should be less than 6 months old. I will put it into there. So in this case, it gives us an overall valuation of 1.4, just over 1.4 million pounds. I can then decide how much do I want to acquire? Do I want to buy all of it? Do I want to leave 20%, 10% with the existing owners? We can play with that when we start to look at different scenarios. But now I've got a starting point for evaluation and deal structures. Sometimes we've had it on calls where the owners will say, I can get far more than that if I just liquidate the business. So that's why we put in the blue boxes here, this figure. So if this owner of this business was to say the same thing to me, so well, you can do that, but you'll get 80% of the net asset value, which in this case is £433,000, which is it's about £1 million lower than what they thought they could get. So sometimes it can help, not always, but sometimes it can help just give them a bit of a reality check into what they can do if they just walked away from the business and shut it down. We've got a valuation now. We've got the historicals. We've got a valuation. Now I want to understand how easy is it for me to structure a deal to make this work. But for me to do that, I want to look at 5-year forecasts. Now, the way I approach this is I look at 5 years worth of conservative growth. Because if I can make a deal structure work at conservative growth, anything that I can bring to the table once I own the business is all upside. It enables me either to put more cash in my own pocket, or I could potentially accelerate any deferred consideration payments. So revenue growth gets put into here. Anything with a yellow cell, by the way, we can enter data into. We can overtype any one of these figures. If I thought, well, actually, I think we can probably do 5 million, I can put that in there. It will recalculate based on 5% growth. I then look at the gross margins assumptions. Well, what we saw earlier on, that the gross margins were fairly consistent at around 22%. So I'm going to run at 21.9% over the 5-year period. Again, if I can make any improvements to the gross margins once I own it, that's all upside. It will lead to the benefit of the cash flow. I then start to look at what my operating expenses would be. This column here gives me is the latest set of statutory accounts, and we use that as a benchmark to calculate what the incremental growth could be as a starting point. That makes sense? Director salaries, on the assumption that the director is the owner and wants to exit, we put an amount in the first year to cover a consultancy period, a handover period. So in the Walking Holiday Company example, I think we allowed for £6,000. We ended up paying 2, so we didn't need that person every day. Next line down is the money that you'll be able to pay yourselves once you own the business. And then we start to get into all of the other lines of overhead. Now, one thing you see here, in the latest set of accounts that we have, £57,000 for staff salaries. It then jumps to 124. Now, the reason for that is at the bottom here, we've got another section where we can start to include any new staff that we think we want to bring into the business. None of us want to buy a job. So what we tend to look at is, have we got anybody in the business who could step up into a more senior role? If we haven't, then do we need to bring a general manager in, and at what salary? So in this example, we've assumed that we'll bring somebody in at £65,000 a year. Other examples might be an administrator, business development manager. There are a whole host of different roles that we could put in here, list them out, and we can determine when they may need to start in the business. So that's on the salary side. We're then working our way through and looking at what our assumptions are for all of the other overhead lines. And we may decide, well, actually, this motor vehicle here, it's a vehicle that's owned by the owner, and we're going to give him it as part of the deal. So my motor expenses might now come down to about £1,000 a month for different bits and pieces. So we can put that in there. It will then recalculate our cash flows for us, which you'll see in a second. We then keep going down. So £24,000 in recent periods for accountancy. But as we know, A lot of that was preparation for sale. Going forwards, my guys can do it for 3. Any legal and professional, well, we've got that in 17 grand, but we also know that that was deal related. So going forward, it might only be £1,000. So let's put that in. What I've now got is a revised EBITDA over the course of the next 5 years. Loan interest in here, we're going to come back to, and I'm going to show you that in a second. It will calculate the corporation tax for us, and if we wanted to, we could put any dividends in there that we'd like to pay ourselves. The only other section in here from a forecasting perspective is this one. Again, going back to the point that I'd made on fixed assets, if we can see that there is a need to replace certain assets, we can factor that in here. So it may well be typically we only spend around 2.5k per year. But we do know that the company van needs to be replaced probably in year 3. And we also need to reduce that production line, that piece of kit that's pretty much on its last legs. We think we can get through it for another year, but we will have to pay 50 grand to replace it in year 2. So let's factor that in. So now we've got our cash flow forecast, so we can start to think about what does a deal structure look like. So next tab along, we're going to look at financing the deal. Here's our figure that we've calculated at 1.4 million. Deal fees, that's what you pay yourselves for doing the deal. Financial due diligence, around 5k. We normally charge that, for any DD that we do. Legal due diligence or legal work, £8,000. I always advise people to put them on a fixed fee. It just sharpens their mind to what you're trying to achieve. SDRT, well, there's the government trying to squeeze every last bit of tax out of us again. So that's 0.5% of the total consideration of the business. That's just for the UK. So we've got a total deal cost of 1.44. Now, how much do we want to pay at completion? And we can play with these numbers as long as we like. So I put in there as a starting point, £500,000. And I'm saying that the remainder will pay over 4 years. Now, just for now, I'm going to take that figure out so you can see. Now, when we look at it, on the right-hand side, it's going to give us a profile for what the cash could look like. There's a more detailed version of this, which I'll share with you in a second. But when we look here, we can now start to see what the closing cash position looks like. And if it's green, I'm happy. This is cover ratio, debt service cover ratio, DSCR. And I'm looking for a minimum of 1.5. And what I mean by that is if I look at EBITDA, I need EBITDA to be 1.5 times or more greater than the repayment of any finance and deferred consideration combined. If those figures are higher than that, I'm comfortable. Because if there are any blips post-deal, I know that I can carry it for a period of time. Now, in this example, we can see our cash gets pretty tight. So then we can start to think about, sorry, let me just take that out for a second. Now we can start to think about, well, what finance do I need to bring in here? So in this example, just for now, I'm going to put in 200,000. Now I can put my assumptions in here for how much it's going to cost me and over how long I can spread that cost. So in this case, I've spoken to my finance broker. So look, best we can probably do this business 5 years, and it'll be about 17%. So once I put that in, it will then work out what those borrowing costs will be every year. Now the cash flow starting to look a bit better, but let's see if we can make it better still. So what I'd love to be able to get to is having these cash flows, these closing balances look healthy without having to raise as much money. So if we just go on now, here's the more detailed version of our cash flows. And I'm going to come to this section in a second, because this is where we can start to play with our working capital assumptions. But what we can see, here's our profits after tax, add back our depreciation. So we're getting back to a cash position. Here's our capital expenditure forecasts. Here are all the deal here are all the deal payments. So there's the payment there to the seller. Here are the deferred consideration payments. deal fees, and here's the loan repayments. And the one figure that's missing from this, the one thing where it will need some negotiation, is your opening cash position post-deal. So in this example, it's £200,000. Now, when we looked at 1/12 of revenue, that will give us an indication of what cash we would like it to be. So we can take that as a guide and put a figure in that said, look, well, if we do this deal, we would want a minimum of £200,000 left in this business in order for us to give us a fighting chance when we start post-deal. Now, what we did with the walk-in holiday company was we agreed a figure of 131,000. Their accountants, bless him, come back with a figure of 40. Said, go sharpen your pencil and have another look. He came back and agreed with us at 131. Now, what we then subsequently said, look, if the cash balance of the business at completion is greater than £131,000, we will pay you that difference within 14 days. So that was just, but if it was less than 131, we would deduct it from a completion payment. So that's just another way that we structured that deal. At the moment, everything seems to look okay, but I want to look at our working capital. So if we go back on now to our working capital assumptions, what we can see here is how the business has done in the last 3 years. So we can see our debtor days gone from 49 and then it's been under 30 days. We've got our stock days. We've got our creditor days. Now, if I look at this, at the moment, it's saying 25 days. I may look at that and think probably a bit ambitious. I'm thinking 29 days is probably about right. So if you keep an eye on that 55k, because if I then put that up to 29 days, it's going to recalculate out the cash impact of the change in debtor days. We can do the same thing for inventory days. We can do the same thing for creditor days. If I'm thinking, actually, yeah, 30 days might be a bit difficult, but I can go to 25. Now it's recalculated the working capital improvements that we could make. If these figures were really high, and I've got a finance team that were really good at debt collection to get those debtor days down, I can model that and see how much cash I can generate. And the more I can generate, the less I may need to borrow to get a completion payment made. All make sense so far? Next one, for Harbour Clubs, we know it obviously as YBOs, but also known as consulting for equity, as I'm sure you all know. Here is a schedule that helps you to understand what a YBO deal might look like. So if we assume in here that we want to take a 20% stake, we can go back into the forecasts and we can put in here, well, actually, I want to pay myself 25 grand a year in dividends over that period of time. That's going to be the dividends that the company will pay. And if we go back into here, it's now going to put my share of the dividends into this model. So we can calculate what our share of any YBO deal could look like. It's also calculating what a future valuation could look like as well. So this is quite handy to be able to show to a seller to say, look, I don't actually work with companies that I don't own. So if you want to work with me, then it's 20% and it's a retainer, whatever you organize with it, whatever you agree with the seller. But what you can do is demonstrate that if we hit all of our targets that we talked about, then the business could look like this over the next 5 years. And the valuation could look like this. So not only can you see what it's worth to you, but you can demonstrate to the seller what it's worth to them. So this is just, again, come off the back of a conversation with another Harbour Clubber who was looking at YBO deals and said, can we put anything into the model that does it? So we did it. Next one along, we can start to think about what if we do this? What if we do that? So on the left-hand side here, if we know that the revenues of the business are 4.6 million, if we can find out how many customers they've got typically in a year and how many invoices are being raised, we can then calculate the average sale and the frequency of those sales. On average, how many times per year are they buying? If we know that, we can then say, well, what if we could increase our customers by 20%? What if we can increase every sale by 10%? What if we can reduce our attrition by 5%? we can put all of these assumptions in yellow. And on the right-hand side, here it's giving us the 22-23 accounts. And here it's giving you the restated 22-23 accounts if you achieved all of this. And there are two figures in orange. One is the impact that it would have on EBITDA. And the second figure is the impact it would have on cash. So now we can start to play with this. Doesn't impact on the valuation. This is something you can start to think about. Well, I think we can do this. I think actually we can get our average sales up by 15%. Maybe I can actually get my frequency of purchase up to 4.5 times a year on average. And we can, and as you can see again in the orange, it's showing us how the business benefits and how you subsequently would benefit from doing it. We've got an offer sequence in there. Bit rough and ready is this one. Typically, what I will do is prepare 6 offers. Clearly, the first offer is the one that I want to do, but each one gives a little bit more away. If I get to a stage where I've got to offer 6 and the owner's still wanting more, I'll say, look, that's the best I can do. I'll leave it open. I'll leave it professional. I'll say, if you can get that deal that you're looking for, take it. If not, why don't we have a coffee in 3 months and see how we get on? What I would typically do is wait 3 to 4 working days between offers. So if they come back and say, yeah, I don't really like that. It's not bad, but I don't like it. I will leave them 3 to 4 days before I get back to them. It's just that little bit of psychology that we build into the process. Next, we have there's a 1-page overview. So again, if you wanted to send something to a provider of finance, this will tell you the historical summary, the deal structure, ratio analysis, the finance required, and the 5-year forecast that you could put in front of, excuse me a second, that you could put in front of provider of finance and say, look, this is the deal in a nutshell. I've got another model sat behind this. If you'd like to see, if you think there's got some legs in this and you think that there could be a potential to raise finance, we'll send you the rest of the model and you can go through it in more detail. We can go through that together. Couple of tabs in there just for slide decks again, or for our business plan, just to cut and paste in. Last one there, I'll start to note any questions that I've got for the seller, broken down predominantly between P&L and balance sheet. And that's the model. So this is how I prepare. And this is the sort of thing that I do for other harbour clubbers as well, but predominantly I use on my own deals. So this is the process that I will go through in order to assess a deal. I've thrown a lot of information at you there, guys. Any questions?
Yeah, in the chat I put one. You said you had a multiple of 2.75 for the industry, and somehow you changed that in the model to, I think, 3.1, not sure anymore. Was that what hypothetically was asked by the business owner, or?
No, what I do is I'll take the 2.75 and I'll look at the business now, depending on the size of the business or the sector that it's in, or the what can sometimes be unique circumstances. I may want to put something slightly higher as an opening position. I may want to go a bit lower. If I think this business is declining, I may be lower than 2.75. But
Yeah,
that's the figure that I enter.
That's also always my thing about averages. If you shoot a meter left of the rabbit and a meter right of the rabbit, you never hit a rabbit. But the average, you hit the rabbit.
Yeah, and that's where it's not an exact science.
Yeah.
You know, this is used to as a starting point for further discussion. Now, once we've done this, if we've pitched it at, let's say we pitched it at 3.1, and it's come out at 1.4 million, as we've seen, and the seller comes back and says, oh, well, my mate down the pub said I can get 4. Well, we're a million miles apart, and I wouldn't take it any further. Now, if they come back and say, I really wanted 1.6, 1.7, well, that's when, you know, to Jeremy's point, you metaphorically bring your chair onto their side of the desk. Say, right, let's see how we can get you to your number. And then it might be a discussion around the multiples. It could be around earnouts or any other deal structures in order to get them closer to their 1.7 if that's what their number is.
Yeah. The rest is quiet. You shut them down.
Hi, Steve, I had a question. On your business valuation tab, you had the multipliers in there.
Yeah.
Yeah. Where did you pull those multipliers from?
Bizbuysell.com. Now we know that they're similar. These are from the US, as you know, but we know that they're also similar to the UK. So we use that again. It's a guide. So we pull those figures through. I'm just about to update for 2024.
Okay, and I'm assuming that they're specific, for a certain sector, but do they also have them specific for different EBITDAs within a sector?
No, they're not the figures that I've seen in the past. So if it's a larger business, then I'll tend to increase the multiple that I would use. So there may be a guide price at say 3. I may go in at 4 because it's a significantly bigger business.
Yeah, that's what I guess that's what my ultimate question is. How would you know to use 3.2, or let's suppose it had an EBITDA of 2 million, should you be using a higher multiplier? And if so, how much more would that higher multiplier be?
That may come down to experience. It may need a little bit of extra research, but typically I'll go with. I'm looking more respecting that I've done quite a lot of these, so I've seen what those multiples may need to be. But again, it comes back to if I look at a business that's doing 2.5–3 million in EBITDA, then I may well do some additional research, because if I go in there at a multiple of 2, it's quite insulting. I think the seller would find that quite insulting. So I would go back and think, well, actually, does it need to be 4? Does it need to be 4.5? Does it need to be 5? If I've got any guide from the seller themselves, I may want to go closer to their multiple. So it becomes down to a judgment call.
Yeah, that's a tough one, because if your goal is to do a roll up and you're assembling half dozen similar businesses in a sector, I'm trying to vision what that value of the roll up would be, once it's assembled, based on the increased EBITDA.
Yeah, and that's something we've got another model that we've put together for groups, where as the business starts to grow and more businesses are brought into it, clearly that's going to have a positive impact on the multiple as well as the combined EBITDA. So we're doing that for the groups that we're building at the moment. So we've got one in leisure, we've got one in HR and finance. We've got another one in we've bought a business that's a motorcycle business in Wales. So again, these groups, as we start to build them up, we can model the impact on the valuation.
Nice. And then last question. I have version 3.1. How do I get version 3.2? I noticed you were using.
Yeah, well, anybody who buys the model, as you know, you'll get a copy of 3.2. So I will send that to you after the call, Steve.
Okay, thank you very much.
Have you also got the how-to manual as well?
No, I don't.
Right, well, I'll send you that as well, because we recently wrote that so to a company, so I'll make sure you get both.
Oh, thank you.
Okay, then that brings us to the question: what does the model cost?
295.
295 rupees.
I wish it was. Yeah, that's sterling.
295.
Yeah.
Okay, and where can you buy it? Is it just?
We've got a link. Bear with me, because let me just switch across to my slide deck. Where am I? There we go. If I go into where, if you let me know once you can see that, guys.
Yep.
Let me just go. I just want to move it up. There we go. So there's 3 ways that we do this for the Harbour Clubbers. If you just want the model itself, there's a QR code. If you scan that, it'll take you through. And what you'll get is a copy of the manual, the model itself, the how-to manual, which is in PDF format. Any updates that we make to the model, you get free of charge. There will also be support from me anytime you need it. So typically when somebody fills it in for the first time, they might get a little bit stuck, or in any other times that they're using it, I'm only a phone call away or a Teams call. So I'm happy to jump on a call and talk you through it. if it's something where you think, well, numbers just aren't my thing, or I don't have the time, we have got a done for you service, about £495, or we'll do all that number crunching for you. We'll put together a list of questions for the seller, and it will also do the valuation and various deal structures and work with you on what a forecast could look like. So we'll do all of that, the grunt work, if you like. If you want something where we just want us to hold your hand through the process, want me to hold your hand through the process, we'll do all the done for you. We'll also do all the paperwork, heads of terms, consultancy agreements, business plans, attend the meetings with you if you want us to, help you to raise finance and do the due diligence as well. Once you've got heads signed, we'll do the due diligence. So that's a full service. But yeah, if you wanted to get hold of the model itself, or to get a done for you service, that use the barcodes on there, or the QR codes on there, sorry.
And financing also on European mainland, like the Netherlands, for instance?
Trickier. It is trickier. We've found that we're looking at business in Portugal at the minute, so we're having to look at a different way. We're going to be raising bonds for that one. So I'm working with Jeremy and another Harbour Club on that. It is trickier, but I've got a couple of people I can put you in touch with that hopefully can help.
Because, well, maybe it's not for everybody, but there is a very profitable company which I know because it's a friend of mine. He wants to sell probably, but I need to figure out a financing way. Okay, anyhow, but it's
Good. Okay. Any other questions, guys? If you do want to get hold of me, if you want to have a call, my mobile number's there. My LinkedIn's here. If you want an online call, there's my diary, or there's my email address. So feel free to get in touch with any questions you've got, or even if you get stuck on a deal and you need a bit of help, happy to have a call with you to talk you through it. But other than that, if there's any other questions?
not for now. It's
I have a question on the WIBO piece and the earnout. I noticed that the example you showed didn't include. So under which circumstances would you put earnout in a deal structure?
Sorry, say that again, Tolu.
So I was thinking, so there are two questions. One was around earnout. One was looking at the WIBO.
Yeah.
Very new to Harbour Club, so just did my training last month.
Okay.
So I noticed in the WIBO piece, you showed us about the dividend, but then also around retainer. How do you put those in there as well? Maybe it's a call and time with you later just to get my head around it.
No, that's fine. So when you look at the forecast, the 5-year forecast page, what you'll get in there is a line just below the directors, which are the figures that you would normally pay yourself, whether you're buying it in full or whether you're taking doing a WIBO deal. If you were to populate that line, those effectively are your retainers.
Right. Okay. Okay. I'll give you a call later on just to get my head around it.
Yeah, of course. Yeah. Any other questions, guys? Let me just check the chat box as well.
Really great looking spreadsheet.
Good. Okay. Thanks very much.
Very comprehensive and very nicely presented.
Good. Well, I'm around. You'll find me in the Harbour Club. You've got my contact details here. Feel free to reach out whenever with anything you want to have a look at or you're not sure about. Happy to help. But unless there's any other questions, guys, I don't think. Let me just check in the. I don't think there's anything else. No, I think that's it. So unless there's anything else, guys, thank you very much for coming along. I really appreciate you taking the time to join us. Just get in touch if you need anything.
Thank you very much.
All right.
Thank you very much.
Guys.
Thanks, Steve.
Thanks. Bye-bye.
Bye.